that is agreed in an open market. Active open market, what the price that you could find for the identifiable item, that will be your fair value, which is the latest definition. Please read IFRS 13, you will find out the correct definition of that. Coming back to now, okay, we came up with the value. Let's say my cost of the asset is 2 million and my accumulated depreciation is 800,000. The cost is how much? 2 million and the accumulated depreciation 800,000. How much is the carrying amount then? 1.2 million. Now we decide to revalue this and we came up with a market value of 1.5 million. The market value how much? 1.5 million. Now, what is the result of this? Yes, brother, tell me, loud. See, now we are very old, we don't hear. 300,000? We have a result of 300,000 and this 300,000 is named as revaluation surplus. Now, this is mathematically we calculate. The same thing, you need to know the double entries for this. So, what is the double entry? Now, see, I have the, let's say this is land or building. I have the cost 2 million. And then I have accumulated depreciation and I have the so far calculated depreciation of this result into 800,000. And by default, please, you have to understand that the assets are debit and the accumulated depreciation are credit. I don't need to come and tell you this again and again. Now, we have to perform the revaluation. See, from an exam point of view, when you do this revaluation exercise, we do in separate different methods. So we don't want to discuss that. You can open a revaluation account or without opening a revaluation account also you could perform. For the sake of our understanding, I will do this without opening. I will show that also, but normally I would advise you do without opening the revaluation. What you do is, if you happen to revalue an asset on that day, it's like the baby just born. So you got to wipe off all the previous age. But I mean, you have to remove all your accumulated depreciation on that particular date. So for me to remove the 800,000, I have to debit here, which I will credit to. So here, building. So the double entry will be debit, accumulated depreciation and credit building. This is the first entry. Now what is the difference here? 300,000. Now this 300,000 is good situation or a bad situation? It's a good situation. Surplus would result into revaluation surplus. So I would have here 300 and I would have 300 over here. Now if you do that, can we balance this now? What is the answer here? 2,000. I will come to explain the accounting entries, but before that, let's work out the maths here. Revaluation surplus. This is the opening balance. This is the depreciation. So what is the balancing figure? 2,300 minus 800, which is, speak out, 1,500. Now this 1,500 is my closing balance and that should be this. So now, double entry. We don't pass, please note that, we don't pass double entries for the balances. There is no double entry for balances. The balance comes as a result of double entry. Now we understood this is a surplus, meaning it's like a gain. Correct? So when it is a gain, the second double entry will be I debit this to the respective asset account, building account, and I credit this to revaluation surplus account. Understood? That's what I did. I have debited here and then I have credited here. And this I will name it as building. Clear? So this will complete the calculation and accounting aspect of revaluation. Now, interesting point is that now we came up with the balance in the ledger 300. Now the question is presentation, or more than presentation, I would say recognition. Going back to IAS 1. IAS 1 says when you produce your income statement, you categorize your income statement into two headings or two segments. One segment only for the profit and loss, the other segment for something called other comprehensive income. IAS 1 talks about how you present your income statement. You segment as profit and loss and as other comprehensive income. Now, we have made a 300,000 gain here. Is this gain available in cash? It is not available in cash. This is yet to recognize, not yet recognized. Or I would write this as unrecognized gain. But it's in books available. I'm very happy. Oh yes, I have made 300,000 gain, but we cannot pay dividends on this because we don't have cash. So the standard says that any such gain or any such deficit, you should never put into your profit and loss portion. So see, your P&L, your income statement, sorry, as I told you, you have two sections. This section is profit and loss and this section is other comprehensive income. Now that gain of 300,000, question is, if you can distribute dividends as the result of that, you disclose under profit and loss. So the bottom line here, we name this as profit for the year. This profit is allowed for the purpose of depreciation. But the gain that I have in my hand got nothing to do with the gain that resulted as a result of a day-to-day operation. It's a special exercise. You carried out a valuation. For that you got this 300. So therefore, we cannot put it under here. It's standard advice you to go and disclose where under this segment our heading is other comprehensive income. I would write gain on revaluation 300. Let's say my total profit for the year is 1,700 for the sake of example. So then I would take the total and this total comes to 2,000. This I would name it as total comprehensive income. This is how you should presenting in IAS 1. Now we have done this. Now then we have to also do something called statement of changes in equity. In short, or to remember well, we used to call SOCE. Statement of changes in equity. This statement of changes in equity is a reconciliation we perform for the relationship of any equity movements.